Your unique story, our global audience. Global One Media.
Hello, and thank you for tuning into another episode of our equity analysis series with Chris Thompson from eResearch. Chris leads the research department at eResearch and offers incisive analysis on various companies to help investors make well-informed decisions. I am Munir Barazi, your business analyst and host, and today Chris and I will discuss Data Communications Management, or DCM, about which Chris and his team have written an update report recently. Hello, Chris. As always, good to see you.
Thanks for having me on your show.
Welcome. So you've recently written an update report on Data Communications Management, or DCM. They've recently released their financial results for the second quarter of 2023. What are the main highlights from the quarter?
Yeah, so DCM has recently completed an acquisition of Moore Canada Corporation. So they had some pretty spectacular results because it now includes 2 months of the combined corporation. So revenue hit $119 million in the quarter, and that's up almost 75% from the same quarter last year. And it was slightly higher than our estimate as well. And of course, most of it has to do with the fact of the integration and with the new company combining the financials. Although in this case, there was only 2 months of 3 months of a quarter were included. So there's still a little bit more room for growth for the whole year-on-year numbers. The important things were that everything was sort of in line with what they discussed during the merger. Growth profit was also up a lot to $32 million. It was up over 50% from the same quarter last year. Although gross margins were down slightly, but that's because the margins from the acquired company were lower. So when you blend the two together, they dropped a little bit, but we're not too concerned because, part of their mandate with this acquisition is to improve the gross margins of the company they acquired. So we are expecting this gross margin percentage to improve in the next couple of quarters as well. Expenses were up, of course, with the merger, but overall, as a percentage of revenue, it was down because the target company, which was Moore Canada Corporation, or MCC, had lower expenses. So overall, the expenses percentage went down. So that's also positive. When you gain revenue at a lower cost, it's always good for the bottom line. And more importantly for the company, and the EBITDA, the cash flow, as we measure usually by EBITDA, it was also up almost 46%. To about almost $14 million in the quarter. And that's important as well. The company did, acquire the target company, MCC, with debt. So the actual total debt did go up fairly substantially. It's over $110 million now. But with this cash flow, they are paying down the debt. And they did a lot of things in the quarter to help facilitate this, and they paid down a lot of the debt where they could with the cash flow from the operation. So it was all in all was a pretty good quarter for the company.
This is a lot to unpack with all of these developments, and I believe it would be helpful for our viewers to download the report from your website for a more thorough analysis. But for the sake of this conversation, how did this impact your financial analysis and valuation?
Yeah, so we didn't have a change in the target price or rating for the company. We did slightly increase the revenue and EBITDA. We had some fairly good information from the company with full disclosure, on their documentation. So we did a merger report a couple of weeks ago. And so we haven't changed it from our target price and our valuation. Everything that they released in the quarter was all positive and in line with what they had previously recommended. So we did a full analysis. In our model itself, we look at the valuation from either a DCF, a revenue multiplication, or an EBITDA multiple as well. And so, it's a blend for those investors who are looking at, how we do our valuation. They can go into the report and they can use their own metric itself. One of the important things for the company, we're looking forward to next year as in the report. Right now the revenue is sort of targeting, $460 million range. The revenue should go up substantially to next year, probably over $500 million once they do the full year integration of the company's financial reports, as well as they're still targeting, a 5% organic growth, on the top line itself. So we're looking forward to that, to see that the continued increase in revenue and EBITDA and the paying down of debt, which should hopefully, de-risk this merger.
Still positive all in all. How do you see the company performing for the rest of this year?
Yeah, so the focus of the company right now is actually on the integration of the acquisition. We believe that by the time it's all said and done with the integration and the revenue increase, the organic revenue growth, we think the company should hit about $520 million, for next year. The company did release news that they have done some organizational changes already, and they believe that those changes in the first 100 days will save them about $4.2 million on an annual basis. The company is looking between, 25 and $30 million of annual savings from this merger, which they should be able to drop to the bottom line, or a lot of it, and pay down the debt. And so we're looking forward to seeing that. In the quarter, they actually did a private placement to help with the cash on the balance sheet. They raised about $26 million, and they've also done some consolidation of the facilities in Canada, which I think should help as well. And they did a sale and leaseback of a facility where they actually raised $24 million that went to the bottom line as well on the debt side. So these are the sort of things we're seeing from the company. What we're looking for is more cost savings that they should announce in the next quarter, as well as their focus on organic growth. They're looking at maintaining that 5% organic growth. And finally, they're trying to get a lot more digital services. The company focuses on, workflow management on the printing and digital management side for companies. And they're trying to move more into the digital software and solutions when it comes to asset management, like content management, document management, all the content you have when you're doing marketing and advertising and printing, all those things. And they're trying to get more digital services. It was a high growth area, but it's still a low revenue side of the business. And I think as they get to the more technical enabled services, they should command a higher premium on the valuation multiples.
Sounds like DCM is working on several fronts to maintain its progress. Chris Thompson from eResearch, thank you so much for your insights and time.
Thank you for your time as well.